Welcome back to the Capital Mindset Show, everyone. Hope you guys are having a great day as always. This one's a special one because I've been really negative with this company in the past. I've been quite negative if you've been following the channel for quite some time. And again, those of you in the community know what stock this is, right? Because we've done something different here. I've changed my tune here. But without bearing the lead, because I don't know if you know by the title of this video or by the thumbnail, because I really don't know what it is. I haven't made it at this point. You might know what stock it is, but it's Disney. Okay, so Disney stock has severely underperformed since about 2015. It has been dead money. And if you recall 2021, there was a massive exuberance, so much excitement over Disney Plus and all the wonderful things they're going to do, and they're going to destroy Netflix and this and that. And recall my Netflix videos of last year, a quite sizable position within the portfolio, and it's done really well. Remember the research we did. What did it say about the shows? Oh, that's right. Disney never made it into the top 10. If they made it maybe with one show here and there, made it into the top 10. Point being, their content's really subpar. Their cinema, their movies are pretty good, but really, when you really break it down critically, they're not that good. A lot of them fall on nostalgia. The Marvel movies kind of live off of their past glories, and there is signs of, you could say, fatigue. Now, they recently had the Avatar movie, but there's mixed feelings about it. There's a lot of just mixed feelings about Disney in general these days. And it is a company that has tremendous amount of IP, no doubt. It's what they do with that IP that maybe can not make or break, but definitely change the long-term outlook of the quality of that IP, whether or not it's still beloved, because there is a point where IP can, in fact, be destroyed. So we all look at the change that recently happened. Well, Chapek was out of nowhere going to be thrusted out. And I really don't think that was really out of nowhere, because there were a lot of people kind of suspect that Chapek was a fall guy of sorts. You had Iger that comes in and frankly kind of ruins the company a bit, and we'll get to that in a second. And then Chapek comes in and makes some changes, runs the business as usual, but it appears as though Iger still has a very influential role. Well, he does. He's a chairman at this point, and he's coming back as CEO. So what's happening? Well, Iger, right? Because that's a hot take. Iger's the bad guy. Well, it's a little bit more nuanced. He is the one that leveraged Disney up to the, if you use your imagination, it's YouTube, I want to be a little bit careful. But yes, he destroyed the balance sheet. And if you forget that, recall Fox acquisition. Lucasfilm's a smaller one, but the Fox acquisition in particular was a pretty big one. And now you went from Disney having a pretty good balance sheet to a pretty abysmal balance sheet. They had to cut the dividend, et cetera. Well, that's more so the lockdowns and everything. But really, it is a very different company now because of the actions of that individual. And you really didn't have a lot of synergies as we thought. The synergies really didn't appear, and they paid nosebleed prices. The shareholders of Fox, of course, they made out like bandits, and Disney ended up being the loser. Disney is also tied down by legacy media businesses, right? There's a lot of encroachment coming in here from the likes of Alphabet. You bet it. You bet yourself with ESPN. They're coming for that. And same with Amazon. So these legacy media businesses that rely on advertising are often now relying more than ever on these other tech giants for their audiences. And consumers are electing to use other ways of consumption rather than going through these legacy media businesses, and that is harming advertising dollars and then therefore Disney's bottom line. Now, one part of the malinvestment that I've criticized Disney over as well has been the parks. If you haven't been to the parks yet, or you don't frequent them often, you may not notice that the parks have been deteriorating in quality across time. And that being said, right, what's the point of going to the parks? Because it's a form of escapism, and nothing is worse than when you're on the ride and you're trying to experience the surroundings, or your children are, and the ride breaks down, which is happening at greater and greater frequency. And a lot of the innovation in each of the parks is really lacking. They've implemented some gimmicky technology to help with some of the interactions with some of the parks, but really it's nothing to sneeze at, nothing that Universal also isn't doing in other ways that is probably more successful than what Disney's doing. And there really has been a lack of new park developments, which Universal, which is owned by Comcast, hasn't really shied away from all too much. Universal has actually been opening up in a lot of new parks, and there's talks, or I think it's already announced and confirmed, that they will be opening up a new park in Texas, something that Disney really should get on, because that is a fast and growing state. I think will do wonderful for the portfolio. You also have extraneous risk, but we'll get to towards the end of the video because I think those are kind of going to be important. But let's talk about the price action because the price action has been abysmal. There's no way around this. 5 years, gone nowhere. Let's look at the longer term picture. Since 2015, this company's only up 15%. Imagine being invested since 2015, only to have gone up slight percentage compared to the S&P 500. Now, again, we had the exuberance and the craze, 2021, they're going to take over the world, they're going to destroy Netflix, etc. Of course, that's not true. And finally, people recognize that. It just took about a year for people to recognize that. And Netflix, no, is not dead. In fact, they consistently are in the top 10 and dominate the top 10 consistently. Again, I said that consistently. Okay. So Disney can get there, but they have to make the proper changes. And that is where the proxy fight comes in. So this is getting interesting now because we have Nelson Peltz, a billionaire, who is famous for his proxy or activist investing. More so focused on turning around businesses that have lost their way. Think Procter & Gamble back in 2017, 2016. Nelson Peltz got involved with the business. Now, that doesn't mean that every single time an activist investor gets involved, that's good for you. It could be bad for you because remember, they're looking out for themselves. They're looking out for their pocketbooks first, then yours, and then in some cases, let's say all of you benefit together. So this could be one of those cases as well, similar to the execution at Procter & Gamble, reinvigorating growth, reinvigorating the brands. Nelson Peltz, if you read into what he's talking about. Now, this is, by the way, this is, I think, from Disney. I think this is the one from Disney. So this is not talking good about Nelson Peltz. In fact, Nelson Peltz has been saying, I'm not going to get rid of Bob Iger. I'm not going to do that. But then proceeds in his proxy statement to basically bash Bob Iger's track record, which I very much agree. And I'm actually really glad that he's bringing that to light because, again, I think a lot of retail investors are blindly in love with Bob Iger, which I found very fascinating because, again, he's the one to blame for a lot of the problems that Disney currently has. So with Nelson Peltz coming in and pointing those things out, I feel like it draws new light onto the company. And if you actually see what he's advocating for, I agree with nearly all of it. One, he calls for a reinstatement of capital allocation via the dividends, deleveraging, and reinvesting back into the parks. Now, what does that mean over the short term? Oh, yeah, that means a lot of capital investment over that short period of time, right? So the dividend is not supposed to be reinvested or reinstated to its former glory per se, but it's just to be there and then kind of over time grow it back to its former glory. But really, the capital investment into the parks, I think, is necessary, and shareholders really are shying away from that. So short-term pain for long-term gain. But that won't be forever. Very much like other stocks like Meta that we've talked about that has a lot of CapEx right now, but that's necessary to grow their hyperscaler, right? But with the case of Disney, you have to grow and nourish the parks, and that's been neglected for many, many years now. Okay, so other parts of Disney that make it kind of... let's say, unattractive is the very generous spend on content. Now, keep in mind, I like to call it the recapture event when a lot of these media companies, they will build an IP, they'll build a movie, and they'll release it in theaters and recover a lot of the costs. In fact, sometimes, if not a lot of times, make a profit from that. So not only are they releasing it to the streaming service afterwards, but they've made a profit already. Whereas Netflix, I was hoping they'd move more in that direction, which it looks like they are going somewhat in that direction, but Disney's been doing that business model for a long time, and I find that very attractive. Now, as far as the TV shows go, I feel like they're kind of green-lighting everything and anything, and if you've seen the live streams in the past and you've heard my thoughts on some of Disney's content, I think it's pretty bad. It's pretty bad, okay? I'm not going to sugarcoat that. It's pretty bad. So there is room for improvement, and I feel like they could be more effective with their spend. Effective is the key word. And really get back to the art form that is cinema, that is telling good, profound stories, good writing, good cinematography, all of that. Not simply resting on the laurels of your IP and just assuming that everyone's going to watch it. And in fact, if you had to push me today to cancel one of my streaming subscriptions, it would 100% be Disney over HBO and Netflix. In fact, I'd probably cancel Disney Plus over Hulu, which is also owned by Disney. So keep that in mind. I think that they own 90% of it, and I think 10% is owned by someone else. I could be wrong on those numbers, so fact check me on that. So what's changed? Again, you're pretty much getting all of that, what I was concerned about on the high level, priced into the stock at this point. So here and around below $100, slightly above $100, it is a vastly different viewpoint than I had let's say a year ago from Disney. So keep in mind where I'm coming from. Okay. My mind changes when the facts change. And now we're talking about Disney at a different valuation with the potential for addressing some of the core issues. And so what I've done is I've actually taken a very small position in Disney. It's very small, but I would be watching and looking to add, and I'm willing to pay a better premium if they can really turn this company around. Now, let's talk about some of the concerns I have. So we'll talk about the out of left field concerns and some of the major concerns as far as the business model goes. Major concerns as far as the business model goes include, but are not limited to, the competition coming from newer players from the likes of Amazon, Alphabet. These businesses are heavily encroaching on their legacy media from the standpoint of advertising. Think of advertising dollars being segued away, and also these companies are competing in on something like ESPN Plus. Right now, you can watch ESPN or other sports hosting services on something like YouTube TV, but don't rest on those laurels, because we know that the big tech players are going to make bids for those primetime spots to cover those sports. And that could be a very big, let's say, sentiment drawdown for something like Disney, where ESPN is not an insignificant portion of the revenue. Now, they can still play ball. They can still, pun intended, by the way, they can still compete here, but not to the same level. It's not just an easy win for them. Okay. Now, as far as the valuation goes, let's actually get into that. So I think for Disney, right now, it's kind of in line with where I'd say it's fair value. I would actually prefer it to come down a little bit more, but you know how I like to do it. I'm going to build out like a watcher position where it's still meaningful, as in if it still does perform well, I can still do well and I'll still feel it. But it's not going to be my most exciting position. It really fits in that narrative that I've been building about supporter positions, and that's what Disney's going to fill out here. Now, I don't for a second think it's going to overtake Netflix. I've already made my choice, let's say, in the streaming wars via Netflix. But as far as content goes, I can't ignore what Disney has. They have it's a massive, massive entertainment conglomerate. You got parks, media, in that entertainment category. You got cruise lines, etc. You pretty much got everything inside of this. It's just got to be managed better. And I have somewhat of faith that they can change the tide around. And so this is kind of like my beginning as myself, my own opinion, that the company can do it. And not that they will do it, but they can do it. And I'll be paying attention. So now I've changed my mind on Disney. I'm actually more so on the leaning kind of positive. Now, the out of left field risks, right? I do not believe we had let's say, a conclusion to the allegations levied against them for their revenues. And to my knowledge, it hasn't been settled. It could have been settled, but it hasn't been settled. And before making this video, I looked and I didn't find any settlement on it. I found settlements on previous allegations, but not on the more, let's say, pertinent one. So that's still there, but let's pretend that that's not an issue. Let's say that's a black swan event. But I'd be paying attention to that, and that almost makes me hesitant to even build it out to any sizable position. Then we also have, of course, China-United States relations, and what would happen in the case of escalated tensions or, knock on wood, conflict, an open conflict. Well, kiss the value of those assets in China goodbye. And a lot of the growth narrative for Disney has been the Chinese market. Getting those media businesses, getting that media content and marketing it towards the Chinese people and generating sales in China. Now, there are other companies that we could actually point to the same thesis or the same story. You can think of Tesla, Apple, Starbucks for even. So all these companies have, or Nike, actually, Nike's another one. So all these companies are really tied to the longevity and health of China and the health of those relations between the Chinese and the United States. So all that being said, I don't consider them all too much. I don't say, oh, that's guaranteed going to happen. No. But I'm still aware of it, and it's still in the back of my mind. with that being said, thank you guys so much for watching. If you enjoyed this video, feel free to leave a like, subscribe if you haven't subscribed and you want to see more content like this, and comment down below, what do you guys think about Disney? Is this a company you have actually been watching for a while? Are you adding it? You're avoiding it entirely because you don't like it? It's an icky business. Let me know. And also, I also am curious, what do you guys think about the new Star Wars shows? Just let me know. I'm just curious to see what you guys think. All right, with that being said, see you guys in the next one.